Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So it's extremely important that correlation that's out there, at least at some cursory level, that you want to be aware of that, okay, and be aware of what's of that correlation. Be aware of an easier money policy, a risk appetite, sentiment that's pushing the market. Because as a trader, Steve, at the most basic level, we want to be on the side of sentiment. Now, how you define sentiment and what time frame you define sentiment is a whole other conversation and topic. But ultimately, if sentiment is bullish in the markets, we want to be on the long side. And if sentiment is bearish in the markets, we want to be on the short side. So as a trader, first really identify with where is sentiment in the market that you're trading, okay? And if sentiment is more risk appetite, it's probably going to be a lower volatility environment. And that's what you want to be keeping in mind as you trade these ICE options. Now, as you begin to find ways and you begin to understand sentiment and play that, there's better ways to maybe put on those positions. But initially, when it comes to going long, you maybe buy some calls. When it comes to short, you buy some puts. You've defined your risk. When maybe you want to neutralize some of your Greeks, okay, you may want to put on some put or call spreads. When maybe you want to, say, you know what, I think the markets are going higher, but I think that tech is going to lead the rally like it has, and the S&P and the banks are going to lag behind. Well, in that case, now you look maybe putting on a long QQQ, a short spider trade, okay, and you take on more of a market neutral approach. A lot of it really starts with yourself as a person. Like, how risk averse are you? What kind of appetite do you have? What's your swing for drawdown? This all comes in your trading plan. And so if a person wants to learn more about that, I put on a few courses a year, but I definitely mentor and work with traders. I really want to, I like working with traders that want to go to the next level though. So, and in terms of if you just want to get started, I have some other suggestions as well. Again, send me an email and I can definitely guide you in the right direction, whether it be with which books you want to read or which class you want to go to. There's a lot of good stuff out there just for free. I mean, just these ISE educational webinars, go through the archives. See some of my past stuff that I've talked about. And I promise, when you start to hear me on a regular basis, I actually don't talk so fast.
Yeah. Hey, John, I have one other question, then I want all the attendees to type all the questions, and then, of course, you handle those. Over the last, let's say, 2 years, we've seen trends in the currency market that were amazing. First, we saw the dollar rally for almost a year, and then we saw the dollar sell off for, a little under, a year, I guess. And then we saw, I don't know if it's a game changer. In fact, that's my question is, December was the first month that the dollar rallied for, I guess, around a year or so. What would make you change your mind that the dollar is going to strengthen, and therefore, what would you do in the other asset classes?
I'd watch the Fed fund futures and get a sense of where the Fed's going to go because, currencies move on carrying interest rate differentials, not on trade balance deficits and whatnot, and there's just ridiculous quantitative data to corroborate that. So right now, and especially in this environment and this, if the Fed begins to back off and Fed funds begin to show that maybe we're not going to get quite the rate hikes we are, and that the Fed, is not going to play catch up with the ECB, then I would, change that opinion. But I think that if the economic data, with the upside surprise we had an NFP back in December, if we get a second number that comes out with that, I think that we can get a second leg down again. Still enough for me to be short volatility. I'm still comfortable with that position. But overall, though, I think that can ultimately unhinge things, and I think that the volatility on the S&P will more than offset whatever short vega I have on the currencies. But net, to answer your question succinctly, which I didn't answer succinctly, but if the Fed funds futures begin to back off, and if we begin to get maybe those euro dollars in 2 years back near highs again, that to me is more indicative that maybe the Fed isn't going to tighten as much as the market's pricing right now.
Well put. Thanks. Why don't you take, John, some of the questions? I see Andrew has a couple questions for you, and everybody else, please type the questions in. John, really knows his stuff, so take advantage of John being here. Please.
Okay. I see. It looks like Andrew's asking a couple of questions here, and maybe Steve, you can help me to make sure that I'm getting these correctly. But Andrew mentioned we're gonna mention okay. Is now a good time to start a hedge fund? Andrew, I'll discuss the timing behind starting a hedge fund and the costs. I go over that during the webinar. In general, it depends on the kind of assets you have. But as a rule of thumb, there's certain provisions out there and exemptions you can have if you're a small size. I'll discuss those and say and why you may want to be a fund and why you won't want to be a fund. But in general, if you can make money, it's always a good time to be a professional trader. The second rule, in terms of the performance rule, i.e., if you are an unknown but run an incubated fund and get good results, will the money come to you? I have some ideas about that as well. In many cases, the answer is no. If you're small and you run a fund, will the money come to you? Probably not. There's a ton of funds out there. There's a ton of managers that have good track records but can't raise a dime because they're either too small, they don't have the infrastructure, they don't have the pedigree, the strategy they have is too new or too dynamic, and a lot of the, unfortunately, what's taken place over the last couple of years is that the big hedge funds that survived got bigger, even though they're not necessarily better, simply because more of a CYA function that people invest, well, they have these provisions, and based on you would think that, like, money would find its way to better managers after what happened, but it's not necessarily the case. It found its way to bigger managers. And the workshop is not listed as an event on osactrading.com. That will be corrected, but again, just send an email and sign up. You can sign up for membership. I'll be updating that. I'm also on Twitter as well. And you can follow me there from my website. But just send an email to info@osactrading.com, and all the info will come across from there. So that's the. Let me go ahead and put that slide back up. It's again info@osactrading.com from there. Any other questions?
Hey, John, could you just go back to that Australian dollar, U.S. dollar chart? Let's take a look at that one more time. Sure. I'm just very interested because it seems like a very good proxy for risk appetite here in the currency markets.
Oh, yeah. Oops, sorry. That was the last slide there. Bang, bang, bang. Bang. There you go. Okay.
That one there.
Yeah. That's the spot market right there. That's AUD USD on the CQG chart that I use.
And what it's very interesting, though, John. It's such a bull trend now, I guess, since what, February or March, and then it rolled over for almost the first time, although it did roll a little bit in June and then rallied back. Right. Sort of a key area here, no?
Very key area. And something that, again, I think that based on what's gone out there, it won't surprise me if this bad boy consolidates or takes another leg lower. I'd be really hard-pressed outside of some really bad economic data. If we get bad economic data, we're going to new highs on the Aussie on this Friday. It's done and done, okay? And so I'm aware of that. And like living in Las Vegas and being a trader for as long as I have and being in the Marine Corps, you better know your outs. Okay, you better understand what can go wrong. In fact, it's better to understand what can go wrong as opposed to what can go right. All right, so you can manage that and account for that. And so for me, if all of a sudden NFP disappoints, okay, then we go from there.
Interesting. Very interesting.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.